Royalties accounted at 12,000, to Raman account 10,000, to short working recover 2,000, surplus, short working recover, short working could not be recovered, transferred to P&L account, paid to amount payable to author. Royalty to Raman account 18,750, by profit and loss account 18,070. Hello, my dear student. I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to hand Advanced Financial Accounting, second semester, Unit 3, Session 8, in favor of royalty account. In the last session, I already told you what is royalty. It is a compensation payable by the lessee, the utilizer of the land, to the landlord, the lessor. There are two parties. One is called the lessee, one is called the lessor. Lessee is the payable of the amount utilizing the particular patent right to whom? To lessor. So the two parties are, one is the lessee, one is the lessor. So we'll go to problem. Raman wrote a book on accountancy and got it published by United Publishers. So Raman is the author, United Publisher becomes the lessee. On the following term, the publisher were to pay royalty of 15% of the sale proceed of each year, subject to a minimum rent of 10,000 a year. The deficiency in sale, if any, of 1 year could be recovered out of the excess in the immediate next year. If there is any shortage come, the shortage should be recovered in the next year only. The publisher had the right to ask for a revision of the book, which the author was obliged to complete in 6 months. This is important. Delay was subject to a fine of rupees 500 per month, and also the rule of minimum rent was not to apply in that year. The question of minimum rent does not arise at all. Now, I am solving the problem without raising the minimum rent. Directly we go with the Raman account. Previously, we are taking the minimum rent account. Here, I am not doing the minimum rent account. Directly go to the author account. Here, number of copies sold 2,000, price per copy 20, 4,000, price per copy 20, 5,000 into 25, 2,000 into 25, 6,000 into 30. Here he says, this is important. The publisher want to pay 15% on the sale as a royalty. Come back here. How many books published? 2,000. Per copy 20. On that, how many percentage? 6,000. Number of copies 2,000 into 20 per copy into 15%. So 2,000 into 20 into 15 divided by 100 is equal to 6,000. This is your royalty of the first year. Now, this goes to 1968. Next, 4,000 into 20 into 15% royalty, 4,000 into 20 into 15 divided by 100, it comes to 12,000. This is your royalty. This goes to 1969. Next, 5,000 into 25 into 15 by 100, 5,000 into 25 into 15 divided by 100, 18,750. This goes to 1970. Then 2000 into 25 into 15 divided by 100. So 2000 into 25 into 15 by 100 is equal to 2000 into 25 into 15 divided by 7500. 1971. Last year 6000 into 30 into 15 by 100. 6000 into 30 into 15 divided by 100. 27,000. So here 2000 copies printed, per copy 20, you get royalty of 15, 6,000, 4,000, 15 is 12,000, 18,750, 7,500. These are all the royalties you have achieved. So it should be put into a chart now. Here number of copies sold, minimum amount payable, minimum rent, royalty, then short working, surplus, short working recover, short working could not be recovered, transferred to P&L account, paid to amount payable to author. So first year, how many copies sold? 2,000. Minimum rent is 10,000. Royalty is 6,000. There was a shortage of 4,000. Whichever is more is 10,000 payable to author. Short working carried forward. This should be recovered in next year. So next year, 4,000. 10,000, you got the 12,000 here. How much excess is there? 2,000. So out of 4,000, how much recover? 2,000 recover. How much could not be recovered? Another 2,000 paid to author, 10,000. So there is a loss of 2,000. Next year, you got minimum rent 10,000, royalty 18,070, payable to landlord 18,750. Next, 2,000, 7,500. Here, 7,500 is payable. In this year, he says, the law. The publisher sent a request revision on 1st January 1971 and the author sent a revised manuscript on 1st November. So, 1st January, February, March, April, May, June. So, he sent on July, August, September, October. So 4 months delay, each delay fine of rupees 500. The published revision 1st January 1974 means that goes to 1970. The author sent the revision manuscript on 1st November 1971. 1st January 1971, January, February, March, April, May, June. He has to send. He sent July, August, September, October. 4 months delay. 4 months delay. So, subject to fine of 500 into 4 means 2,000 fine he has to pay during the year 1971. In this year, the question of minimum rent, the publisher had the subject to ask for revision, which the author has to do it. Delay subject to fine of 500 per month. So, 7,500, royalties of 7,500 payable to landlord. 10,000, 27,000, 17,000 is payable to author is 27,000. So we'll move on to journal entry in the books of unit and publisher. So we are not raising the minimum rate, you are raising the author account. Royalties account debtor, short working account debtor to Raman. Instead of minimum rate, we can write Raman account. Royalties account debtor, short working account debtor to Raman account. We paid to Raman account to bank account. Whatever the royalty transfer to profit and loss account. Profit and loss account data to royalties account. Then royalties account data 12,000, to Raman account 10,000, to short working recover 2,000, Raman to payable 10,000, Raman to bank account 10,000, royalty transfer to profit and loss account, profit and loss account data to royalties account 12,000, then profit and loss account to short working 2,000, that's the fine. For how many months? 4 months. Royalties account data to Raman account 18,070. This is the fine. Actually, for how many months? 4 months. Per month 500. 500 into 4 is 2,000 is fine. There's a loss. Profit and loss account data to short working account be transfer of irrecoverable profit and loss account. Royalties account data to Raman account being royalty payable to Raman. Raman account data to bank account being payment made to Raman. So in 1970, profit and loss account data to royalties account 18,750. In 1971, royalties account data 7,500 to Raman account 7,500 being royalty payable to Raman. But there was a fine for 4 months. Per month 500 into 4 is 2,000. Royalties account data to fine account. Out of 7,000 point, how much you could not get? 2,000. Then Raman account data to bank account. You are payable to Raman only 5,500. Profit and loss account data to royalties account 7,500. Fine account data to Raman account 2,000. So 1972, royalties account data to Raman account 27,000. Raman account data to bank account 27,000. Profit and loss account data to royalties account 27,000. Ledger to Raman 6,000 by P&L account 6,000, to Raman 10,000, to short working recoverable 2,000, totally 12,000 by profit and loss account 12,000, to Raman 18,070 by P&L account 18,000, to Raman 7,500 by profit and loss account 7,500, to Raman account 27,000 by profit and loss account 27,000. Short working to Raman 4,000 by balance carried on 4,000. How much recovered? 2,000. How much could not be recovered? Another 2,000 rupees. Now, Raman account data 2, bank account 10,000. What is this is? Royalty 10,000. 2 bank account 10,000 by royalty 10,000. 2 bank account 18,750 by royalty 18,070. 2 fine account 2,000. 2 bank account 5,500 by royalty 7,500. 2 bank account 27,000 by royalty 27,000. Fine account data to penal account 2,000 by Raman account 2,000. Generally books of Raman, the author, United Publishers account data, 2 royalty receivable, 2 short working allowable. Then bank account data to United Publishers account, royalty receivable to profit and loss account. Then 1969, United Publishers account data 10,000, short working allowable account data 2,000, to royalty receivable 12,000. Then we receive from United Publishers bank account data to United Publishers account 10,000. Transfer to royalty, transfer to P&L account, royalty receivable to profit and loss account 12,000. 19. Short working allowable to profit and loss account. United Publishers account data to royalty receivable 18,750. Bank account data to United Publishers account 18,750. Royalty receivable account data to profit and loss account 18,750. 1971, United Publishers account data to royalty receivable 7,500. Fines account data to United Publishers account 2,000. Bank account data to United Publishers account 5,500. Royalty receivable to P&L account 7,500. Profit and loss account data to fines account 2,000. 1972, United Publishers account data to royalty receivable 27,000. Bank account data to United Publishers account 27,000. Royalty receivable to profit and loss account 27,000. Ledger, royalties account, United Publisher to royalties account, royalty to profit and loss account, United Publishers 10,000, short working 2,000, to royalties account, to profit and loss account 12,000, By United Publisher 18,550. To P&L account 18,050. By United Publisher 7,500. To profit and loss account 7,500. By United Publishers 27,000. To profit and loss account 27,000. Hope you understand this. Then short working. By United Publishers 4,000. Balance carried down 4,000. By balance brought down 4,000. How much recover? 2,000. How much you could not recover? Another 2,000 rupees. Irrecoverable. Then United Publishers to royalty receive 6,000, short of 4,000. By bank account 10,000. United Publishers account, bank account it ought to mention what is royalty receivable 10,000. Bank account it ought to United royalty receivable 18,050. Files account it bank account it ought to United Publishers 5,500. To royalty receivable 7,500. Then here United Publishers account royalty receivable by profit and loss account 27,000. Transfer entry by royalty receivable 27,000. By P&L account 27,000. You are paying to United Publishers by profit and loss account 27,000. I think here we have done under United Publisher also, under author also. Both the books have done without raising the minimum rent. Hope you understand. We'll meet in next session with one more problem. Till then, goodbye. Meet in next session.